If you are under 45 years old, everything you have been told about retirement is already wrong. And most people are not going to figure that out until it's too late to fix it. I have spent over 40 years managing money, betting billions of dollars on where economies are headed, and I'm telling you right now, the system you are counting on to take care of you when you stop working is not the system your parents retired into. It is not close. The pension is gone. The math on Social Security does not work, and the house you think is your retirement plan is not going to save you either. I am not saying this to scare you for no reason. I am saying it because I have watched entire systems collapse that everyone assumed were permanent, and the people who got hurt the worst were the ones who never questioned the plan they inherited. I have sat in rooms during currency crises, during banking collapses, during moments when institutions that people trusted their entire lives simply stopped working the way they were supposed to, and I can tell you the warning signs looked a lot like what I see today in how people are approaching their own retirement. So stick with me, because what I am about to walk you through could be the difference between working until you are 75 out of necessity or having real freedom by 55. Before I go further, I need you to do one thing for me, and I promise it costs you nothing but a click. What I am about to explain to you in the next 25 minutes is the same kind of thinking that has guided decisions on billions of dollars. This is not fluff. This is not generic advice you already heard from your uncle at Thanksgiving. If you find this valuable, and I promise you will hit subscribe right now before you forget, it is free. It takes 2 seconds. And it means you will not miss the next video where I break down exactly how I would build wealth if I were starting from zero today. Let's start with why the old plan is dead, because you need to understand this before anything else makes sense. When I started in this business back in the 1970s, the average person had a very simple formula for retirement. You worked for one company, sometimes for 30 or 40 years. That company gave you a pension, meaning they promised to pay you a check every month for the rest of your life after you retired. On top of that, you had Social Security, which was designed as a supplement, not a primary income source. And on top of that, most people owned their home outright by the time they stopped working. 3 legs on a stool: pensions, Social Security, paid off house. That stool does not exist anymore, and I want you to really sit with that. Pensions in the private sector are almost extinct. Companies figured out decades ago that guaranteeing a lifetime income stream to every employee was a liability that could sink the business, so they shifted the risk onto you through 401 kilobits plans. Nobody sat you down and explained that this was a massive transfer of risk from corporations onto individuals. But that is exactly what happened. You went from having someone else manage your retirement to being responsible for managing it yourself, usually with very little training on how to do it. Think about what a pension actually was: a promise from a company that regardless of how the stock market performed, regardless of how long you lived, they would send you a check every month until you died. That is an enormous liability to carry on a corporate balance sheet, especially as people started living longer and companies faced more competition globally. So over a couple of decades, that risk quietly moved from the company's books onto your household's books, and almost nobody explained it to you in those terms. I have sat across the table from some of the smartest economists and policymakers in the world, and I can tell you plainly, the people who built these new systems knew exactly what they were doing. They were solving a corporate balance sheet problem, not a retirement problem for regular families. Meanwhile, Social Security was never designed to be anyone's full retirement plan. It was built as a safety net, a floor, not a foundation. And that floor is under serious strain because of something very simple that nobody wants to talk about honestly. There are fewer workers paying in relative to the number of retirees taking money out. That is not a political opinion. That is basic arithmetic. And arithmetic does not care about your feelings. So when you add it up, if you are under 45, you are likely retiring into a world with no pension, a Social Security system that may pay reduced benefits or push the retirement age back, and housing prices that have made the old idea of a fully paid off home by retirement much harder to achieve on a normal salary. Think about the math on housing alone. In the 1980s, the average home cost roughly 3 times the average household income. Today, in a lot of major markets, that ratio is closer to 6, 7, even 8 times income. That is not a small shift. That is a completely different game. Your parents could realistically buy a home in their late 20s on one income and have it paid off by retirement for a huge number of people under 45 today. That timeline simply does not exist anymore, which means the third leg of that old stool, the paid off house, is either arriving much later in life or not arriving at all. The stool has one leg, maybe, and it is wobbly. You cannot build a retirement standing on one wobbly leg, which means you have to build your own stool from scratch. And most people have no idea how to do that. Now let's talk about the mistake that I think is going to hurt more people than almost anything else. And it is the mistake of confusing safe with smart. I have made a career out of understanding risk. And one thing I learned very early is that what feels safe emotionally and what is actually safe mathematically are often two completely different things. Most people under 45 have been taught that keeping their money in a savings account or in something ultra conservative is the responsible thing to do. I understand the instinct. Nobody wants to lose money. But here is what nobody explains to you clearly enough. Inflation is a silent tax that erodes your purchasing power every single year, whether you feel it happening or not. If your money is sitting in a savings account, earning close to nothing or even earning what feels like a decent interest, great, but inflation is running higher than that rate. You are losing money in real terms every single year, even though the number on your statement is going up. I watch this happen to people I grew up around. They thought they were being careful. They thought cash was king. And 20 years later, that pile of cash bought a fraction of what it used to buy, while the cost of housing, healthcare, and education, the things that actually matter for a comfortable retirement, went up far faster than their conservative savings ever grew. This is the trap. Playing it safe with cash feels responsible in the short term and is actually one of the riskiest things you can do over a 30 or 40-year time horizon. The real risk is not volatility in the stock market. The real risk is outliving your money because you are too scared to let it grow. I have made some of my best decisions in markets by understanding that risk is not the ups and downs you see day to day. Real risk is the permanent loss of purchasing power over decades. If you are under 45, you have decades ahead of you, and that changes the entire risk calculation. Short-term swings in the market do not matter nearly as much as most people think they do, because you have time to ride them out. What matters is whether your money is actually growing faster than the cost of living is rising. Let me give you a simple way to think about it. Imagine you put $50,000 into a savings account today, earning a modest interest rate, and inflation runs at roughly 3 to 4% a year on average over the next 30 years, which is not an unusual assumption. Historically, even if your account balance grows on paper, the actual purchasing power of that money, what it can actually buy you in food, healthcare, housing, could be cut nearly in half by the time you retire. You would look at your statement and feel like you did the responsible thing, and yet you would be poorer in real terms than the day you started. That is the silent part of the tax I'm talking about. Nobody sends you a bill for it. There is no line item, but it happens every single year, whether you notice it or not. So I want you to ask yourself, honestly, is your current plan protecting you from inflation? Or is it just protecting you from the discomfort of seeing your account balance move around? Those are two very different goals, and only one of them actually builds real wealth. This brings me to what I believe is the single greatest advantage you have if you are under 45, and it is something money cannot buy back once it is gone. Time. I have traded through recessions, booms, crashes, and recoveries, and if there is one lesson that stands above all others, it is this. Time in the market, combined with the power of compounding, is the closest thing to a guaranteed edge that exists in investing. Let me explain why this matters so much for your generation specifically. Compounding is not linear. It is exponential, which means the growth in the later years of your investing life dwarfs the growth in the early years. but only if you give it enough time to work. Someone who starts investing seriously at 30 and lets their money compound until 65 is given their money 35 years to grow. Someone who waits until 45 to get serious has cut that runway nearly in. Half the difference is not twice as much money at the end. Because of how compounding works, it can be 3, 4, even 5 times as much money, depending on the rate of return, simply because of when the money went to work. This is why I get almost frustrated when I see people in their late 20s and early 30s sitting on the sidelines, waiting for the right time to start investing, waiting for a crash, waiting for certainty that will never come. Nobody, including me, after 4 decades of doing this professionally, can consistently predict the short-term direction of markets with precision. I built a career reading macroeconomic trends, and even with all of that experience, I would never tell you I can consistently call the next 6 months of the market. Anyone who tells you they can do that with certainty is either lying to you or about to be wrong. What you can predict with much higher confidence is that a diversified position in productive, growing assets held over multiple decades has historically compounded wealth for patient investors far more reliably than trying to the time entries and exits. Your advantage under 45 is not that you are smarter than the market. Nobody is smarter than the market consistently, not even me, and I have the scars to prove it. Your advantage is that you can afford to be wrong in the short term because you have decades to be right in the long term. That is an asymmetry that people in their 60s simply do not have anymore. If you waste your 30s and early 40s being too cautious, you are giving up the one resource you can never get back. Let me put actual numbers to this so it sticks with you. Imagine 2 people. One starts investing $500 a month at age 25 and stops entirely at 35, never adding another dollar. After that, just letting it sit and grow. The other person waits until 35 to start and invests that same $500 a month all the way until 65, assuming a reasonable long-term average return. The person who started at 25 and stopped after just 10 years almost always ends up with more money at 65 than the person who started 10 years later and kept contributing for 3 full decades. That is not a trick. That is not a gimmick. That is simply how compounding works when you give it more time to run. This is the part people underestimate the most. It is not about how much money you put in every single month. It is about how many years that money has to work for you. You can always make more money later in life. You cannot buy back the years your money should have been compounding. Now I want to talk about something that makes people uncomfortable, and that is the danger of outsourcing your future to institutions that were not built with your best interest as the top priority. I already touched on Social Security, but I want to go deeper here because I think people misunderstand the actual risk. It is not that Social Security is going to disappear entirely. That is unlikely. The real risk is that benefits get adjusted, the retirement age gets pushed back, or the purchasing power of what you receive ends up being much lower than what today's retirees are getting, because the system has to adapt to demographic reality. Here is the simplest way I can explain the demographic problem. When Social Security was first designed, there were roughly 40 workers paying into the system for every one retiree, drawing benefits out of it. Today, that ratio has collapsed to somewhere around 3 workers for every one retiree, and it keeps shrinking as birth rates decline and people live longer. You do not need an economics degree to understand that. A system built for 40-1 cannot function the same way at 3-1 without something eventually giving, whether that is higher taxes on workers, reduced benefits for retirees, a later retirement age, or some combination of all 3. On top of that, you have longevity risk, which almost nobody plans for correctly. People are living longer than previous generations, which sounds like good news, and it is, but it also means your money has to stretch further than it did for your grandparents. If your grandfather retired at 65 and lived to 75, his money needed to last 10 years. If you retire at 65, there is a real chance you live to 90 or beyond given advances in healthcare, which means your money needs to last 25 years or more. Nobody is telling people this clearly enough. You are not just planning for retirement. You are planning for a retirement that could last longer than your entire working career did. This is why relying on your employer's 401 kilobits match alone, or assuming Social Security will cover your basics, is such a dangerous bet. These systems were built for a different demographic reality than the one you are going to retire into. I am not telling you to panic or to distrust every institution. I am telling you that personal responsibility for your own financial future is no longer optional. It is mandatory. And the earlier you accept that, the better positioned you will be. And it is not just years that get more expensive. It is the cost per year. Healthcare in retirement is one of the largest expenses most people underestimate. And that cost tends to accelerate exactly in the later years of life when you have the least ability to go back to work and earn more. So you are not just stretching your money across more years. You are stretching it across years that are, on average, more expensive than the ones before them. This is exactly the kind of compounding problem that catches people off guard because it does not show up until you are already retired and it is far too late to adjust course. The people who thrive over the next 30 years will be the ones who took ownership of their own financial education instead of assuming someone else, whether it is the government or their employer, was going to handle it for them. So let me tell you what I would actually do if I were 30 or 40 years old, starting fresh today, knowing everything I know now after 4 decades in this business. First, I would make sure I understood the difference between owning productive assets and owning things that just sit there. Productive assets are things like ownership stakes in growing businesses, whether through individual stocks or broad index funds, real estate that generates income, or a business you build yourself. These are assets that can grow in value and often generate cash flow over time. This is different from things like an oversized primary residence that you live in, but that does not generate income, or cash sitting idle losing value to inflation. Second, I would prioritize consistency over perfection. I have seen too many smart people paralyzed because they were trying to find the perfect investment or the perfect entry. The person who invests consistently every single month for 30 years, even through downturns, almost always outperforms the person who is waiting for the perfect moment that never arrives. Third, I would take concentrated, informed risk when I was young and gradually shift toward more diversification as I got closer to actually needing the money. This runs counter to what a lot of financial advice tells you, but hear me out. When you are 30, a temporary 30% drawdown in your portfolio is almost irrelevant because you have decades to recover. When you are 62 and about to retire, that same drawdown could be devastating because you do not have time to wait it out. I built my entire career around this idea of sizing risk to your actual ability to withstand it, not to some arbitrary rule of thumb that ignores your age and your time horizon. A 30-year-old and a 60-year-old should never have the exact same portfolio because they are not playing the same game anymore. One is still in the accumulation phase where time can heal almost any mistake, and the other is entering the phase where preserving what they built starts to matter more than chasing extra growth. Your risk tolerance should shift as your time horizon shrinks, not stay static your whole life. Fourth, I would treat financial education as seriously as I treated my professional career. Because in a world where institutions are shifting more responsibility onto individuals, financial literacy is not optional anymore. It is a survival skill. And finally, I would stop comparing my timeline to my parents' timeline. Their playbook does not apply to your reality. You are not failing because you cannot follow the exact path they followed. You are simply playing a different game with different rules. And the sooner you accept that, the sooner you can build a strategy that actually works for the world you live in, not the world that no longer exists. Here is my challenge to you, and I mean this seriously. Do not close this video and go back to whatever you were doing before without taking one real action. Pick one thing from everything I just walked you through, whether it is finally opening that investment account you have been putting off, increasing your contribution rate, or simply sitting down this week and calculating what your actual retirement number needs to be, given how much longer you might live. Write it down. Set a date on your calendar for this weekend to actually do it. Because intentions without a deadline almost never turn into action. I have seen that pattern play out with investors and with everyday people my entire career. The people who end up financially free are not the ones who had some secret nobody else had access to. They are the ones who took the information they had and actually acted on it consistently over a long period of time, while everyone else waited for a better moment that never came. You have an advantage right now that you will never get back once it is gone, and that advantage is time. Do not waste another year of it standing still. If this video gave you even one idea you did not have before, subscribe, share it with someone under 45 who needs to hear this, and I will see you in the next one, where we go even deeper into exactly how to build this out, step by step.